In this video, we're going to be taking one of my favorite characters from a TV series called Money Heist and looking at a business related to Nairobi's clocks and currency. The video is going to be about adjustments and closing. Adjustments and closing are the final steps in the accounting process. Based on what we've talked about so far, we've pretty much just been talking about journalizing and posting to a ledger. But there are a few more things that have to happen, particularly because we follow accrual accounting. So let's take a look at number 1. Because revenue is to be recognized when earned and expenses are to be recognized when incurred, which are the two principles we looked at in the previous video, deferral adjustments must be made so that companies may abide by these principles. Deferral adjustments, accrual adjustments have to be made so that we can abide by revenue and expense recognition. Before we get too hairy in talking about the details, let's look at an example. Letter A. On December 1st, Nairobi paid $3,000 for rent for December through February. What entry is needed December 31st at the end of the month? Well, let's step back up a little bit. On December 1st, what happens? December 1. Nairobi paid $3,000 for rent. So our cash is going to go down by $3,000. And we're going to have to debit something for $3,000. But what do? Do we debit rent expense? Well, the answer is no. Because again, expenses are recorded when they are incurred, meaning the activity leading to the cost has happened. Well, our occupying this facility for December, January, and February hasn't happened yet. It's only December 1st. So what do we record? We record prepaid rent, which was an asset account, right? So that was December 1. But now it's December 31. And what do we need to do? Do I need to do anything? Well, yes, I do, because I do not have any longer $3,000 of prepaid rent. Why? Because December has happened. The only months yet to happen are January and February. So what do? Well, I need to reduce my prepaid rent account by the amount of rent related to December. This is 3 months for $3,000, so it's $1,000. What do I debit? Well, if I've actually occupied the facility for the month of December, then the activity leading to the cost has happened, and I have an expense. What kind of expense? This would be rent expense. So I'm going to debit rent expense and credit prepaid rent. This is my adjusting entry. What are adjusting entries? Well, they're entries made at the end of a period to make sure my asset account has the right balance and my expense account is recorded in the right period. So, my asset in this case, it helps to record my asset at the right balance, which should not be $3,000 but $2,000, and my expense in the right time period, because the $1,000 for December rent should be recorded in December. Okay, let's take a look at the next one. On December 1, Nairobi collects $4,500 from customers for maintenance services to be performed during the months of December, January, and February. So, on December 1, what did Nairobi do? Well, Nairobi collected cash from customers, so our cash went up by $4,500. What did Nairobi credit? Well, she would not have recorded revenue for this. Why? Well, because she hadn't done the work yet, right? She had not fulfilled her performance obligation. This work was to be performed during December, January, February, which these months, as of December 1, right, haven't actually happened yet. So what would she have credited? Well, she would have credited deferred revenue, a liability account. Now that we're at the end of the month, letter B, on December 31, what needs to happen? Well, we can't record the fact that she's earned all $4,500 of revenue because not all of the services have been performed yet. She has performed the service now, December 31, for the month of December, but the months of January and February haven't happened yet. So we cannot record the fact that she has earned revenue for everything, right? She has earned revenue, and I can get rid of deferred revenue of how much? Well, 1,500 of the 4,500. That's 1/3. There's 3 months. And since I'm taking it out of the liability, I no longer owe the customers for these services, I can record service revenue for 1,500. Now again, what does this accomplish? Well, this adjustment helps me make sure that my liability has the right balance and that my revenue is in the right period. When did she perform the services for December revenues? Well, December. And so this revenue should be recorded in this month. That is an adjustment that we would make at the end of the period. And letter C. Letter C, on December 1, Nairobi purchases $600 worth of supplies on account. So what do we do here? December 1. We got supplies, 600, and it was on account. So we owed $600 for those supplies. Now, at the end of the month, after we go out and physically count the supplies, December 31, we see we only have 550 of supplies left. So I don't want to keep telling people that I have 600 of supplies, because I don't. I have to adjust that account. So what do? Well, if 50 of the 600 that I added to the supplies account is now gone, then I'm going to take out of the supplies account $50. Anytime we use up the benefits of an asset, we expense its cost. We used up the benefits of these supplies, and so we're going to record supplies expense. Now, this adjustment as well is helping me to make sure that my asset has the right balance and my expense is recorded in the right period. So I have to make these entries, these adjusting entries, at the end of the period, because I, as a company, have to follow accrual accounting, revenue and expense recognition. Those are what we call deferral adjustments. They're deferral adjustments because when I pay money or receive money, I don't record revenues or expenses. I defer them or put them off until they're earned or incurred as the principles tell me to do. Now, accrual adjustments are a little bit different. Looking at letter D, on December 1, Nairobi schedules an appointment on December 31st for a clock repair that will cost the customer $1,000. Customer will pay in January. So what do we do here? On December 1, we scheduled the appointment. Well, does that change my accounting equation? No. I wrote down a name in a notebook, in a calendar. I don't do anything in my accounting system. December 31 comes, and I do the repair. The customer is not going to pay me until next month of January. So do I even need to record anything here? The answer is yes. Because what has Nairobi done on December 31? Nairobi has fulfilled her performance obligation, which means she has earned service revenue. We're not getting paid yet, so we have to record the fact that our customers owe us the money, which is accounts receivable. Now, why do we do this? Well, this helps me ensure my revenue is in the right period and my asset has the right balance. You get the trend here, right? If I don't make these adjusting entries at the end of the period, my accounts are not going to be correct. And letter E, what do we have? December 1, we hire an assistant who we're going to pay $1,300 a month. Each month's payday will be the first working day of the following month. So on December 1, we hire a new assistant. They work for us throughout the month of December, but we don't pay them until January. Do I record anything here at the end of the month? I do. Why? Well, my employee has earned, I should say, money. They haven't received it yet, right? But they've earned the money because they worked for us. Since they've earned the money for working for us, we have incurred that cost. So we should record salary expense for $1,300. Now, we're not going to pay it right now, and so we need to record the fact that we owe for salary, and so we have salary payable $1,300. Now, what does this do for us, right? This makes us ensure that our expense is in the right period. When did they work? December. Expense needs to be in December. And it helps us to ensure our liabilities have the right balance. Letter F says on December 1, we take out a loan from a local bank for $10,000. Now, I think I changed this in the handout. With $25 of interest payable every 6 months, and we're going to pay back the loan at the end of 2 years. So, what do we do? Well, we're not paying back the loan, and we're not paying any interest. So, do I need to record anything? Well, I do. I have to pay $25 a month in interest. Now, I'm only going to actually pay it every 6 months. But when did I incur this $25 interest cost? Well, I had the money for the month of December. I incurred $25 of interest cost. In January, another $25. February, another $25. When 6 months has gone by, I'm going to have to pay all of that money to the bank. So I have to record here the cost I have incurred for borrowing money, which is called interest expense. Now, I'm not going to pay this yet, so I have to record the fact that I owe this money to someone else, to the bank. $25 interest payable. So I owe the money, I've incurred the cost, but I haven't paid it yet. But the key point here is I have an expense, because what is the activity that's happening leading to the $25 charge? Well, the activity is Nairobi having the money from the bank for the month of December. That's already happened, so she's incurred the cost. Now, what does this do for me? Well, this makes sure my expense is in the right period, and my liability has the right balance. Just like we've been looking at. If we don't do these things, we're going to have a problem in our records. Letter G. On December 31st, Nairobi completes a $500 repair job for a customer not billed yet. So we did the work December 31, but we haven't actually done it yet. What do? Well, we're going to record the fact that the customer owes us money, $500, and we've earned the money, $500. What does this do for us again? Well, it makes sure that our asset has the right balance and our revenue is in the right period. So these adjusting entries are required, right? We have to do them, because if we don't, these things aren't going to be true. But the question and the key point here is that, is anyone going to tell us to make these entries? It's not as simple as somebody handing us a bunch of cash saying, oh, well, now we have a bunch of cash in our hand, we better record something, right? These entries require us to understand what needs to happen based on what we've already done. So they're a little bit trickier to master. Now, this last one, which I'll have to label H, is a little different. Depreciation is another adjustment that most companies are required to make. In accounting, depreciation is the process of expensing long-term assets, like buildings and equipment. As a cost allocation method, depreciation expenses a portion of the cost of an asset each year for its useful life. So we're not talking about valuation here. We're not talking about valuation. We're talking about what is called cost allocation, which is different. Now, we will get much more detailed into this when we get later on in the video series, but for now, the basics are all you really have to grasp. Here it tells us in H that depreciation expense for the year ended is December 31st is $1,100. So what do we record? We record depreciation expense as our debit. We are expensing $1,100 of the cost of our long-term assets like buildings and equipment. So, if I purchase supplies and I use them up, I record supplies expense, right? If I pay in advance for rent and I use it up, I record rent expense. So if I use up the benefits of my prepaid rent, I expense it. If I use up the benefits of my supplies, I expense it. If I use up the benefits of my equipment, I expense it. Now, the difference here is what we credit. When I use up prepaid rent, I credit prepaid rent. I get rid of it. When I use up my supplies, I credit supplies. I get rid of it. I don't have supplies anymore. When I use up the benefits of my equipment, I can't credit equipment because I still have the equipment. And as we've talked about, assets have to be recorded at cost. So I can't change the cost of the equipment. What do? Well, I use a new type of account for us. called accumulated depreciation. This is a new type of account because it is what is called a contra asset. It is a contra account. Contra meaning contrary, contradictory, the opposite of. It is a contra asset because it is an asset with a credit balance. As we know, assets normally have a debit balance. Cash, accounts receivable, prepaid expenses, equipment, buildings, all debit balances. But accumulated depreciation is what we call a contra asset, meaning it's an asset with a credit balance. All we're going to do in this account here is credit it when we record our expense. So we'll see how this relates to the balance sheet when we get to that point in a few minutes. So these adjustments are very important for us. What happens next? Well, we need to look at the process of accounting. In the process of accounting, we have three basic processes that we go through. The first is the recording process. And this is what we've been looking at in the video series so far. We do journal entries, we post them to our T accounts, and we build what's called an unadjusted trial balance. Unadjusted because adjustments haven't been made yet. After that, we prepare our adjusting journal entries, like these here that we've just recorded. When we're done with these adjusting journal entries, we post them to the ledger accounts so that we can have adjusted balances and build an adjusted trial balance. That's the adjusting process. That's what we're trying to look at in this video. Now, once we have an adjusted trial balance, step number 6, we can build the good old financial statements. Then we have one more process that happens after that, which we'll look at here in a second. So, here is our adjusted trial balance for Nairobi's business, December 31st, 2024. Now, I think I may have changed the dates to 2025, but that's okay. So, this is our adjusted trial balance, meaning we've done all 6 steps so far. What happens next? Well, we build our financial statements. So let's take a look at Nairobi's financial statements. Here we have Nairobi's financial statements. The first statement that will be put together, again, I changed the dates, but that doesn't really matter very much, is our income statement. Our revenues from our trial balance, here, $7,500. Then we list our expenses, which are already in order if we've prepared the trial balance correctly. And we put them over here on our income statement. Again, one thing you'll notice, again, this is not a financial statement because it has debits and credits on it. Our financial statements, like we have here, don't have any debits or credits. So we have service revenue, and then we have our expenses. As you will see, expenses are typically listed from greatest to least. And we have a net income, $36.85, which means that they were profitable. Now, from there, we go and we build the retained earnings statement. What did they have to start with? December 1st. They had $34.40. Net income, again, comes from from the income statement to our retained earnings statement, and we have a retained earnings December 31st. We haven't paid any dividends, so that's still 0. But these two statements, again, have the same time periods. They cover the same period of time. Nairobi's Clocks and Currency was profitable during the month of December. They've accumulated a total amount of profits retained in the business of $71.25. We have our income statement, retained earnings statement built from our adjusted trial balance. Then we can build our balance sheet. The balance sheet has current assets listed, cash, supplies, and prepaid rent. We have equipment, and this is the key part. This is the new part that we're adding in this video. Before we simply had equipment, and now we have a new section. Equipment less accumulated depreciation. Again, we said accumulated depreciation is a contra asset, meaning that it has a credit balance. If it's a credit balance, then it offsets an asset account. The accumulated depreciation is the expensed amount of our equipment. Then we have net. What is the difference between what we paid for the equipment and how much we've expensed of the equipment? Our equipment net is $16,700. This number is also referred to as the book value of the equipment. The value in the book. Okay? This is not the same thing as its market value, or sometimes what is called its fair value. That's how much it's actually worth to somebody. These are not the same thing. The book value is the amount we have left to expense. The market value is what somebody would pay us for the equipment. Again, those are not the same thing. So that's a key thing to remember. But the rest of this balance sheet is essentially the same. We've not changed anything else from the previous video. We're just adding in this accumulated depreciation piece. Now, the last thing that we need to look at is the final process. And the final process is called the closing process. In the closing process, before we look at this and try to understand it, we need to take a look at the accounting equation. For our company here, what does their equation look like? Now, we can summarize this equation by dividing up all of our accounts into their basic categories. If we do that, we see that in assets, the company has $29,250 of assets. That's taking into account all of our asset accounts. Liabilities, we have $14,525. And then under equity, again, we've got common stock. And the common stock amount is $7,600. And we have retained earnings. And the retained earnings we have to start the period is $3,440. Now, if you look at this and you add these three things up, what you're going to find is that they add up to $25,565. That's taking into consideration these liabilities, the common stock, and the retained earnings. Now, if that's all we do, what do we have here? We do not balance our assets out. $25,565, $29,250. Doesn't work. That's because we're missing some accounts. As we've looked at before, under retained earnings, we have revenues. Now, our revenues were $7,500. Our expenses, if we added them all up, they would total $38.15. And with dividends, we had 0. So this is our equation. And now if we add all of these things up, we're going to equal our assets. But why do I do this? Why do I draw this out in a visual way? The process of closing has to deal with the kinds of accounts that we use. These accounts down here, revenues, expenses, and dividends, are what are called temporary accounts, because we only want their balances temporarily. So revenue here. This revenue account is telling us about how much revenue was earned during the month of December. When I start January, where do I want to start counting January revenues from? Do I want to start counting January revenues from 7,500, or do I want to start counting January revenues from 0? Well, if I'm starting over a new month and I want to know how much revenue I earned in January, I want to start from 0. The same goes for my expenses. All of my expenses are amounts that I incurred during the month of December. How much utilities expense, supplies expense, etc. from the month of December. When January starts, I want to start over. I want to start from 0 with all of these expenses. Now, is that true for my cash? Well, no. When I finish December, I have $10,000 in cash. When I start January, what do I have? Well, I still have $10,000 in cash. And so these blue accounts that we have up here are called permanent accounts. Now, we have other words for these, but these are the easiest words that we have to understand. Temporary, permanent. So the process of closing the books is moving temporary account balances to a permanent account. That's what we're doing in closing. Now, I can't go into these accounts and just make them 0, because if I do that, what happens to my overall equation? Well, as we saw before, it wouldn't balance. So I can't just go into these and delete them. I have to move their amounts to some permanent account. Now, what permanent account am I going to move them to? Well, it only makes sense to move them to the account that they are attached to, right? So if I do that, what happens? Well, to make revenue 0, what am I going to have to do? If I'm going to make revenue 0, I have to debit it for $7,500, and that will zero out the account. But if I debit revenue for $7,500, what do I have to do? I have to credit something. And so I credit retained earnings for $7,500. Revenue, right, as we said, makes retained earnings go up. Expenses, to delete and make all of the expense balances 0, all of these balances over here, I'm going to have to credit each of those accounts. And so if I credited all of them, I would essentially credit them for $3,815, which would make all of my expenses now, instead of all of these numbers, it'd make them 0, right? And so if I credit expenses, I'm going to have to debit retained earnings. A debit and a credit, right? It has to be balanced out. Now, dividends is the same way. It's 0, so I don't have to worry about it at this point. But if I do that, right? Now, my revenues and expenses have 0. What's in my retained earnings account? My retained earnings account balance should now be $7,125. The amount that we said retained earnings should have. Now, the retained earnings account, right? This number, 7125, was calculated based on my retained earnings statement. That account, that amount there, went to my balance sheet. But the retained earnings account, the actual T account, doesn't have that amount in it, right? What does it have to start with? $34.40. It's not until the closing process that this actually gets changed. So these last three steps, right? Closing journal entries, posting them to the ledger, and a post-closing trial balance have the goal of turning all of these accounts, these temporary accounts, balances to zero. Okay? So what does the journal entry look like to close the books? What do these journal entries look like? In my journal, I would simply make another entry. Now, I need to zero out all of my expenses and revenue accounts. Now, I can do this a couple different ways, but I'm going to show you the easiest way to do this. My closing entry. First, I have to get rid of my revenues. My revenue has a credit balance of $7,500, so I'm going to debit service revenue for $7,500. Now, when I post this to my T account, which I'm not going to show you, but that's the next step, right? Posting to the ledger. If I post this to my T account, then that balance will turn to zero. The next thing I have to do is I have to make all these expenses zero. So how do I do that? Well, I have to credit all of those expense accounts. So salary and wage expense, I'm going to credit for $1,300. Once I post that, it's zero. Depreciation expense, $1,100. Once I post that, it'll be zero. We have rent expense. Rent expense was $1,000. Once I post that, it'll be zero. Utilities expense was $340. And once I post it, it'll be zero. Supplies expense. Supplies expense was $50. When I post that to the T account, that'll make it zero. And then interest expense. Interest expense was $25. And once I post that, it'll be zero. Now, that's going to make all of my revenues and expenses zeros, which is what I want to do. That's the goal, right? But this journal entry doesn't balance. As you'll see, we have $7,500 in revenues on the debits, right? And we have all the expenses over here as the credits, which all the expenses add up to $3,815. So what do we do to balance this entry out? What do we need down here? How much of a credit do we need? All we need is based on our income statement, right? What is the difference between revenues and expenses? The income statement difference, right, between revenues and expenses was $3,685. That was net income. So we need a credit of $3,685. Again, this is equal to net income. And where do we add net income? Net income is added to retained earnings. Where have we seen that before? Well, if you look at the retained earnings statement, December 1st, retained earnings, $3,440. What did we add to it? We added net income. So once I add net income to my retained earnings account by crediting retained earnings here, once I credit retained earnings and post this credit of $3,685, what's going to happen to my retained earnings account? If right now my retained earnings account has $3,440 and I post a $3,685 credit to it, I am going to have the amount that I have on my balance sheet, which is, if I remember correctly here, $71.25. That's going to be my ending balance in retained earnings once I make this closing entry. So this closing entry, right? What does it do? It takes the difference between all of my temporary accounts and it puts it into a permanent account, retained earnings, so that we can start over from scratch for the next period. So accounting as a process, what we call the accounting cycle, has 10 steps to it. Steps 1, 2, 3 are pretty easy. Journalize, put in the T accounts, make a trial balance. Once you get past step 3 and you record your adjustments, find your adjusted trial balance amounts, prepare your statements, and do closing, these get a little more tricky. The process gets a little more tricky. But it's important to remember the basic pattern of process. Journal entries, T accounts, a trial balance. Journal entries, T accounts, a trial balance. Journal entries, T accounts, a trial balance. This process repeats itself. Each one of these processes has the same flow. So adjustments and closing, very important topics. Spend time, study it, make sure you master it before you move on to other material.